So Johnny, tell us a little bit about your history in a condensed form. Walk us through the chronology.
I grew up in the manufacturing business and the retail mobile homes and into manufacturing from there. And I was a large depositor and was invited on a bank board. And 6 months later, I owned the bank. So that's kind of how I rolled into banking. I'm not a banker. I'm a businessman, and I run my banks like they're a business. And it is. I mean, it is a business. And don't tell me something can't be done if I think it can be done, because we'll challenge that and try to be the best. And as you see, I think Forbes ranked us best bank in America 2 years straight in a row.
And so when you think about Home BancShares, one of the statistics that really stands out is your efficiency ratio. So you spend $4 of your revenue on your costs. The typical bank spends $6 of its revenue on its operating expenses. So talk about efficiency. Why is efficiency important? And also, is efficiency a mindset, or is it just a series of discrete tactics?
I think it's more a series of discrete tactics. Bank of Oklahoma, we're still friends today. We got within $1 of making a trade back years ago. And I said, what are you going to do with it? And they said, well, you're a little fat in some areas. We're going to skinny it down and get it more efficient, and we're going to grow it. And I thought, well, we didn't make the trade, so I'll just do that myself. So we hired Metavante as a consulting group to come in and help us. And I don't trust consultants. If they knew what I mean, they come in their $2,000 suits and their $500 briefcase and their shiny shoes. And I told them when they got there, I said, I don't trust you guys, but I'm going to give you a shot. And I said, if you do a good job, I'll tell the world you did a good job. If you do a bad job, I'll tell the world you did a bad job. And I have to say, they did an absolute excellent job. The key there was who headed it in our company, and who is my right arm today is Donna Townsell. And Donna had been in banking 6 months, and my chief operating officer chose her to head this major task. And I said, you don't like her? He said, I like her fine. But he said, I said, she doesn't know anything about banking. He said, perfect. She doesn't know this won't work. She doesn't know that won't work. She'll try all aspects of everything. As it turned out, we took 78 of our best people. Donna headed the program. We created 270 initiatives. They created 270 initiatives for our company, and we instituted all 270 of them. And I started watching our efficiency ratio improve. And management backed her 100%. We stayed hitched to her. And it became mathematical calculations. A lot of our company is run off the numbers. There's a daily report, P&L statement that I created that comes out every day, and it is the Bible in our company. And executive management all reads that Bible, because I don't need to wait till the end of the quarter or the end of the month to see that something's wrong. I see it tomorrow. I see what happened today, what yesterday looked like today. And we'll react, bam. And they'll hear from me on a weekend. I'll light them up. Oh, did y'all see this? What happened here? What happened there? Just a businessman following 5 or 6 key numbers. So we did the efficiency. As Donna said, we did efficiency before efficiency became cool. And it began to feed on itself. And we have 11 regions in our company that all report upstream to our CEO of our bank, Tracy French. And they had learned something that would save money in one of those regions, and they'd pass it throughout the system. And anyway, it became a way of life in our company. If I walk in tomorrow to look at your bank and you think I'm looking at the pretty art on the windows and your fancy desk, I'm not looking at that at all. I'm looking at your teller window to see how many tellers you got in there and how busy they are. I mean, some people think they got 14 teller windows, they got to have 14 tellers. It's a mathematical calculation of how many transactions they do. They do so many transactions, they get 1 teller in our bank now. They do twice that many, get 2 tellers. Do 3 times that many, they get a 3rd teller and a CSR. So that's kind of how it works. Everybody in our corporation, it has become a mindset in so many ways as who can be more efficient in the region. It's become a competition because they don't have any peers. There are very few peers that operate as well as we operate in the marketplace. It's just business, and we're not fat and lazy. And you don't walk in our banks and see somebody's feet propped up on the desk smoking a cigar. That doesn't happen. You know, we work in our banks, but I reward our people. They're multimillionaires, and I'm thrilled about that they have had the opportunity to put themselves in a position, and I gave them a chance to win. Here's how you win. So many of them are in stock programs. I put all my people in stock programs, my top people, the ones who make themselves stars. You know, you watch Sunday football, and you watch this linebacker on the backside. He makes you look at him because he's a star. He's the first one to the football. That's exactly what I'm talking about in the bank. I'm looking for those people who make themselves stars. Donna Townsend's made herself a star with what she's done, so she's moved straight up to the executive ranks. Now, think about it. She did everything in the company, dealt with every piece of that corporation when she's dealing with the efficiency side of it. So she knows everything about the company inside and out, and it's become so important to our corporation. Tracy French came up through our company. Stephen Tipton, my chief operating officer, is 36 years old, a 36-year-old COO of a $15 billion company. Probably the youngest in the country, but I knew his granddad and I knew his dad. I know the stock he comes from, the family, how sharp he was, and he's just blossomed through the company. So I love to see those stars. We have a chairman's award. We give the chairman's award once a year to those individuals that separate themselves from the pack, because Home separated themselves from the pack, and I like to find those people that separates themselves from the pack.
So let's talk about growth. So you guys have grown through doing a lot of deals. You've done 24 or so deals. Sure. As a general rule, you know, in the industry, 2/3 of deals, it's said that 2/3 of deals impair the acquiring bank's value as opposed to creating value. But if you look at your stock history and your total shareholder return, you've obviously created an immense amount of value. Sure. What is different about your growth strategy, particularly your M&A strategy, relative to other M&A strategies in terms of the value creation aspect?
It either works or it doesn't work. It's not complicated. You know, doing the numbers, but when you look at putting Bank C in with Bank A and B, it's not a complicated, you don't have to hire investment bankers to spend hundreds of thousands and millions of dollars. You can do it. I do mine on the Big Chief tablet. I have a big yellow tablet. They laugh at me, but I do my numbers on a tablet. And then from there, we run the models and make sure they dot my I's and cross my T's, but they laugh at me. I did a $3.2 billion deal out of Arkansas, $2.3 billion deal out of Arkansas, Liberty Bank transaction, and they found my notes and they framed them and put them on the wall as 2 yellow sheets. It wasn't exactly what came out of the computer model, but it is pretty darn close what came out of the computer model. The difference is I'm not going to do a deal because I want a bigger salary. I mean, the first 10 years of this corporation, I took not one penny, zero. I didn't even turn in an expense ticket. I didn't put myself on the payroll. I was not on the payroll. I was not on the insurance. I had a phone, one of my lines in my office, I paid my own phone bill. So it's serious business to me. It is my largest asset. And so I'm not doing a trade with somebody to say I'm the chairman of a $15 billion company and you need to pay me what these people say a $15 million chairman's worth. I'm not interested in that. I'm interested in, as the largest individual shareholder in this company, and as all my people are vested in the stock, as my board owns with Johnny about 10%, a little less than 10% of the corporation, it's serious business to us. So there's no reason for us to do a trade that doesn't make sense. And we have thus far, we've done about 21 deals. We've never diluted. You hear this about 4-year dilution to earn back the tangible book, 3-year dilution. Now think about that just a minute. Let's assume the tangible book's $9 today, and some CEO does a deal and dilutes it to $8, and you don't get back to 9 for 4 years. And then you don't think he's not going to do another deal between now and 4 years, and then he does another deal and dilutes you again. So do you ever get back? Does a poor shareholder ever get back to where he started? In most cases, the answer is no. I've never done a dilutive M&A deal that diluted my shareholders 1 penny. Why is that? Because I'm the largest individual shareholder. Would I do that if it was a great trade that made lots and lots of sense? What happens is they'll tell you, yeah, it's a great market, and boy, we got this, and the household income's this. That's all window dressing. What's the number? What do the numbers say? When we put these two together and we suck out the savings out of this deal, what do they look like, and what does the company? Does it increase the tangible book? Does it increase the EPS? We call it AAA. We coined that. Accretive, accretive, accretive. That came from us. And some other people have followed with that. But our deals have been accretive to book value, accretive to tangible book value, and accretive to EPS. Nobody else in the country's done that. And you think about, I'm very proud of this company. We paid out in the last 2 years $360 million in dividends and stock buybacks. Buying back stock is dilutive, right, to me, because I've traded over 2 times tangible book. But I've still returned over 20% return on tangible common equity to my shareholders. I don't believe there's another bank in the United States can spout those numbers.
All right, last question for you, Mr. Allison. So, banking is, you've been through a few cycles in banking.
Sure.
But the technology change that is going on in banking today, a lot of people are saying that this is a revolution that's going to fundamentally transform banking. And we've heard kind of this same argument before in the past, right? Whether it was when ATMs came out, even when phone banking came out.
Sure.
What is your take on the transformation in banking today? What is it going to take to be successful in the future?
Well, I think it's headed that way. I'm not sure when or where. They said, what was it? 10 years ago, 12 years ago, 15 years ago, we're getting rid of all checks. We're getting rid of all checks. There's so much crime on the debit card side right now, more people are going back to checks. So I don't know that it'll ever take over banking. I think there'll be some aspects of that are really positive to banking, but I'm not going to spend the money. This company makes, when we run 2% return on assets, we make lots of money in this company. So not only do we keep a bunch of that, we stick some of it back. We're sticking back about $10 million a month, just sticking it back for a rainy day. That's a lot of money, right? We buy back about $10 million in stock a month. We could shut that down if we needed to. We will have plenty of capital to step out and buy into something. If you think about ATMs, I remember when the guy first had the ATMs introduced in Arkansas, and he was renting them all these other banks, and he had a lock on the world, I thought. And then greed sets in, he started selling them. So somebody built a better mousetrap, and somebody took the patent, died, and anyway, it all broke out, and everybody's got ATMs. Now they're ITMs, right? So my attitude is we run our bank, continue to build a fortress balance sheet, and don't chase the rainbows out there that a lot of loan officers are chasing today, and just stay hitched. Think about it. I got $11 billion worth of loans on the books, over 6%. My book is over 6%. So I don't have to make that silly loan the next day. Just let that, as I told my people yesterday, they told me, hey, somebody's coming in doing something at 2.75. I said, let them go. That's insane. I said, just let our $11 billion churn out here at 6+%, and I will get the next deal. That's just the way it is. But we bankers have created these payoffs. We are the ones responsible for creating this monster with all these payoffs because we asked for so much equity in the deal.
Well, that is all the time we have, Johnny. Thank you so much for doing this with us.
My pleasure. I appreciate the opportunity. I love to tell the story.